if I look at what the large risks are on the horizon, the central bank environment has changed at the margin. You know, we only have to go back 6 to 8 weeks and we're still in a very positive, very accommodative environment. Only the Fed was hiking rates. Fast forward to now, we've got the Bank of England being hawkish, we've had the RBA talking about a 3.5% neutral rate. I believe that was a miscommunication more than a signal, but we've seen the Bank of Canada hike rates, and now we've got the Fed and the ECB talking about, you know, tapering and unwinding their balance sheet respectively. So I think that has changed, and I think as we move forward, if we do see inflation pick up, and we can come to inflation, but if we do see inflation pick up, we do get into a tighter monetary environment and we can see interest rates rise. Now, if that happens, that changes the valuations across almost every asset class, whether it's US equities or whether it's Australian housing. And I think that's the big risk. So you take the step below that and you've really got to look at inflation and what's happening there. 3 key factors that I see driving that is energy prices, and we have seen oil rebound a little bit. Technology, which is deflationary by nature, that's probably going to continue, so that's a key deflationary impact, sorry. And the third factor is wage growth. Whereas we were seeing sort of 4% wage growth in the US, now that's down to sort of 2.5%, and even in Australia it's quite stagnant. In Europe you've got a mass of slack in the labour market, so you've still got probably not that key wage driving inflation up either. So I look at that and I sort of see 2 of those factors remaining fairly constant and only energy prices increasing. So at the moment, we still have some room, if you like, before that inflationary pressures pushes interest rates up too high. So a big risk, I think, over the next few years, but just not at the moment.